Insider buying is a bullish signal because management ultimately buy because they see the share price increasing, and today we're jumping straight in. We're looking at buys of at least 100 shares of at least $100,000. We're going to look at 6 today, run through them, our own valuation as well. Now the first one, we do in fact see Nike, the director bought on the 27th of December, around 2,500 shares, and that cost just under $200,000. Now looking at the company, not the greatest performance. Earnings haven't been great over the more recent time, negative 30% in 2024, and over the last 10 years it is up around 53% but has underperformed the S&P 500, and we can see all-time highs. We're talking over 3 years ago at $178. Now we see it right now trading at its 52-week low. We get a double buy from both Seeking Alpha and Wall Street, and it also pays a yield of 2.2%. Now when we take a look at their earnings over the next 4 quarters, they are expecting the continuation of the decrease to the EPS year on year, but what we do like is their historical forecasting accuracy has been pretty good. They have outperformed 4 out of 4 of the last quarters, 100% track record, and if we look towards May 2026, their EPS estimate, that in turn will lower the forward P to around 28.2. In terms of looking at some of their gradings, well, on the valuation, they get a D-. If we look at the P of around 35, what this signals to us, it trades well above the sector median, and in fact, if you're buying this company right now, you are paying a 100% premium to the overall sector, and that is something that is reinforced no matter what valuation metric you use, that this company is trading at an overall premium. Is it worth the premium? Well, look, the growth grade itself is a D-, given their year-on-year revenue is negative 5%. The sector median is low single digit, nonetheless it is positive. The decrease is expected to continue into 2025 with the sector, whilst not great, again low single positive digit. And we also notice the earnings per share of this company only 3% over the next 3 to 5 years on a year-on-year basis. The sector a lot better at 10.5, so maybe there is an argument to say it isn't worth the premium, but when we do look at the profitability, that is quite key where they get an A+. We can see their gross margin sits around 45%, better than the sector at 38%. Their bottom line also impressive at around 10 versus 4.3, and we can also see this company does generate a lot of cash from operations, 6.12 billion to be exact, in comparison the sector at around 275 million. So one thing to note then, we did see the double buy rating from Seeking Alpha and Wall Street, although the valuation fairly poor, D- as well as the growth, with the profitability one of the strong points here at the A+ level. Now in terms of the dividend safety, well 99, that is the highest score obtainable, very safe, and we also notice an 8.1% high single digit increase in November last year. We also want to flag dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year average, 2.22, well above the 5-year rolling of 1.1, and in fact the highest they have offered over the last 5 years. That is one way of looking at a severe undervaluation signal. But the other thing we do have to note, if we look at their forward P at 38.8, that is above the 5-year of 32. Now what we're going to do for each one of these 6 is run it through the valuation model, where for Nike we get just under $96, and when we do our classic deep dives, we talk about the inputs and outputs. Today, jumping straight through, we allocate a 10% margin of safety, which we execute on every company if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, then a buy at around $86. Then we keep going till it's near the current trading price, and what we can see for this company today, you're looking at a 25% MOS, with Wall Street themselves indicating 25% upside. They did give it a buy rating, and they see this at $90 over the next year. As we go along, don't forget to give us your thoughts about these stocks today. We also want to let you know that we have released our latest free weekly article, which we drop every single Monday morning. We cover what severely undervalued stocks there are in the market, as well as what's gone on over the last few days. So if you click below, you can sign up, read straight away. where you'll be able to gain access to 46 undervalued stocks for the month of January. Lots of information for each one, the upside that Wall Street themselves see over the next year, and we have just released today a copy of 43 stocks that Wall Street themselves believe right now have the most upside in the S&P 500. So click below, you can sign up and start reading these straight away. The next stock of insider buying, we actually get two instances here. On the 17th of December, it is ConocoPhillips, where we see around $1 million worth of insider buying, and then we also see this again on the 20th with around 239,000. So quite a significant amount. ConocoPhillips, this company as well, trading at its 52-week low thereabouts. We actually get a triple buy rating all across the board, a fairly attractive yield at 3.5%, but over the last year, down around 13%, and over the last 10 years, it is up around 62%. But remember, this is if you had bought 10 years ago. For example, if you bought around the COVID drop, it was trading around $26, you would be up nearly 4 times. In terms of their earnings, bearing in mind cyclical industry, they do anticipate only one of the next 4 to be actually growth to the EPS, but always great to see out of the last 4 quarters, at a minimum they have been in line, although we have noticed some substantial beats. In terms of their forward P, based on December 2025 earnings per share, it does sit around 12.2. When we look at their ratings, while growth they get a C-. In terms of comparison, pretty much 12.9, not far off the sector median at 12.13, although different valuation metrics may come to a slightly different conclusion. In terms of growth, they get a B-. Now year on year, negative 8% with the sector at negative 1. Forward looking, negative 10, sector at 1.14. But one thing that we do like, a little bit better than the sector median as well, earnings per share expected growth 8% versus the 6.36 of the sector comparative. In terms of looking at the profitability, well, they get an A+, 49% gross margin, 46 from the sector comparative. Bottom line, 17.5 versus 11.4, and we also see massive cash generated from operations, 20.9 billion versus 577 million. As we said, triple buy rating, not too common on this channel, C- valuation, B- on growth, with an A+ on profitability. In terms of dividend safety, they do get a safe 61 score, and they did increase the dividend last October at 34%. When we talk about dividend yield theory, again, another undervaluation signal, 3.12 above 2.12. However, we do note the forward P is above the 5-year at 13.4 versus 11.8. In terms of the valuation, well, quite a lot of margin of safety today, intrinsically $139. And as we do go through the MOS today, as we said, a fairly substantial amount, around 30% at 97, and at around 25%, this price does sit at 104. So 25 to 30%. With Wall Street themselves, we did get a buy rating, in fact a triple buy, 35% upside with Wall Street's 135. And don't forget, you can click on the pinned comment below to grab a copy of this model to run your own numbers, whether it is for COP or any others. We then move on to Occidental with Berkshire Hathaway on the 19th of December buying just under 9 million shares. That did cost them over $400 million. Now when we take a look at this company, not the greatest, especially over the last year, down 13%. Over the last 10 years, in fact, also down around 35, although we can see it trading around $10 in March 2020. Right now, you'd be up more than 5 times. And we do, in fact, notice trading towards the lower end of the 52-week range. In fact, if you were to buy this right now, you would be buying it at a price lower than Warren Buffett's cost average himself. And we do get a triple hold right across the board, in fact, opposite to what we just saw earlier. In terms of the yield, 1.73%, and when we do take a look at their earnings, again, another cyclical industry, only one of the next 4 quarters to be growth, but as we say, we do quite like to see this historical forecasting accuracy, 4 out of 4 beats. With the EPS of 356, their December 25 forward P comes to just over 14. In terms of their ratings, well, valuation a D+, as we do notice a little bit higher than the sector median, so you are paying a 22% premium, and that is pretty much something we see a fairly marginal premium no matter which metric you do use. And then on the growth, a C-, negative 7%, sector at negative 1, revenue negative 8.5 moving forwards, sector positive again, but very marginal. And then we take a look at their profitability, looking very strong, 62% versus 46. Bottom line, 16% better than the 11.4, and the most impressive thing, like we have seen in previous companies, cash generated from operations, 11.3 billion versus the 577 million. So again, triple buy rating across the board, D+ on valuation, C- on growth with an A on profitability. Then we get to their dividend safety, which does sit borderline safe at 60, and we also want to point out their latest dividend increase sitting around 22%. When we look at dividend yield theory as well, very large difference, 1.73, well above the 5-year, so an undervaluation signal, although we do have to point out the forward P, 16.6, does sit above the 5-year 12.8. In terms of the valuation at just under $64, when we do run through the MOS today, what we in fact see right now at this price, 20% margin of safety, with Wall Street giving this 20% upside. They expect this, even with their hold rating, to hit around $61 over the next year. We then move on to LVMH. In just the last 90 days, we can in fact see net insider buying at 137 million euros. And when we take a look at some of the most recent buys, in fact, you will see the CEO himself buying quite a large number in December, the 2nd, the 5th, as well as the 24th. In fact, as we can see at the early stages of December, he bought around $10 million. And as we just highlighted, a lot of shares have been bought even over the last 90. In terms of the company, well, over the last year, down 13%. Over the last 10 years, still massively outperformed the S&P, up 323%. All-time highs pretty much sitting around the $1,000 mark last year. And we do also note they pay a yield of under 2%, and we can see their P on a trailing 12 basis at 21, below the S&P 500, with Seeking Alpha giving this a buy. If we take a look at the valuation of LVMH, well, our intrinsic value of $820, again, a fairly nice margin of safety, pretty much around the 20%, just a few dollars shy, although we do have to point out that Wall Street over the last few months have continually been decreasing their price forecast. Right now it sits at $735 and they only see 11% over the next year. As we always say with their forecast, always take it with a pinch of salt and don't really use it or rely on it for your own overall investment thesis. We then move on to two other companies, although they're not right at their 52-week low, so a bit of a bonus for the episode today. We have Lowe's, where in fact on the 20th of December, the director bought around $245,000 worth of shares, and also one we haven't covered on the channel in a recent period. We get a buy rating from Wall Street, trading at the mid to lower end of the 52-week range, a yield of 1.84%. Over the last year, up around 15%. Over the last 10 years, outperformed the S&P, up 264%. We also like the fact we see green right across the board, also growth anticipated over the next 4 quarters, although not a lot. We are talking low mid-single digit, and based on their January 2026 earnings per share, the forward P sits just below the 20 mark. In terms of the gradings, well, valuation in F, as we can see, in comparison to the sector median, you are paying around a 21% premium, and again reflected on the vast majority of valuation metrics. In terms of the growth grade, it does sit at a D, negative revenue year on year with the sector positive. Same to be said, forward looking, -4 versus +3. And we do also notice earnings per share actually not looking that great at all, only 1% over the next 3 to 5 years, with the sector comparative at 10.5. Profitability looking a little better at an A+, 33% gross margin, although that is below the 38 of the sector median, and then net margin 8.2, better than the 4.3, but again, like the majority today, cash from operations 10 billion, with the sector median at 275 million. As we said, just one buy rating today from Wall Street, F on valuation, D on growth, with an A+ on profitability. In terms of dividend safety, very safe score, 93, with their latest increase being in May last year at 4.5%. And when we take a look at dividend yield theory, this is a reasonable signal given 1.84 is bang on the 5-year average, although the forward P, 20.4, does sit above the 5-year 17.8. So in terms of the valuation today, we get to $266, which when we do run it through the MOS at 10%, it isn't actually at that point right now. We see this company around 5 to 10%, probably not one that we would consider for the portfolio, at least in this moment in time. Although Wall Street don't agree, as we saw, they were the only one with the buy rating. Their price target, $291. They see 17% upside over the next year. And as always, do give us your thoughts below. We then move on to global payments, with the director on the 13th of December buying 5,800 shares for just under $700,000. When we take a look at the company, down 15% over the last year. Over the last 10 years, not far off the S&P, up 161%. Similar to Lowe's, trading at the mid to lower end of the 52-week range, with just one buy rating from Wall Street. The yield itself below 1%, forward P sitting below 10, and when we take a look at their earnings, we do quite like this. Pretty strong growth expected around the double digit over the next year, although they did miss, although marginally, their most recent quarter with a 75% track record. And as we can see, based on their 2025 EPS, the forward PE will come down to around 8.8. In terms of valuation, a D-, although we do notice if you are looking at the forward PE right now, you are getting a 21% discount, and that is really dependent on which valuation metric you use. Some agree with that, we have others that show a marginal premium. And then we get the growth at a B-. Revenue not far off, 6 versus 4.6. Forward looking, again, not far off, 5.8 versus 5.5. And we can in fact see here the same to be said on the EPS over the next 3 to 5 years, 9.8 versus 10.4. In terms of profitability, looking good at an A-, 63% gross margin versus 60% of the sector. Bottom line, not looking too good in comparison, 14 versus 22. And the cash from operations, 3.54 billion, a lot higher than the 136 million from the sector comparative. As we said, just one buy rating from Wall Street, a D- on valuation, B- on growth, with an A- on profitability. Dividend looks to be safe with a 70 score, but do bear in mind they haven't increased the dividend since 2021, and when we do look at dividend yield theory, it is above the 5-year average, and the forward PE does sit below the 5-year rolling, giving us that double undervaluation signal. In terms of the valuation today, $139. When we look at the MOS at 10%, a buy at 125. At 20%, pretty much around the current price. So for GPN, we see 20% margin of safety with 21% upside according to Wall Street and their buy signal. $137 is where they see this in the next year. As always though, do give us your thoughts about these 6 stocks today, whether you've also been adding to these, maybe they're on your watch list. Don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we do cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.